Okay, let's jump right in. We are doing a deep dive into the gold price, XAUUSD, for mid-November 2025. And right now, it's trading around $4,100 an ounce.
Which is, dangerously close to its all-time high.
Exactly. And that's really the mission for us today, isn't it? We need to understand how we can have these small, volatile dips in the short term
Right.
when everything on the long-term chart is just screaming that this is a dominant bull market. How do you square those two things?
It's the central question. And if you look at the big picture first, the foundation is, well, it's rock solid.
So the technicals are all lined up.
Perfectly. I mean, all the major trend lines, the moving averages, they're stacked in this stable upward trajectory. And the long-term conviction, it's just exceptionally high.
And what does that mean, conviction?
Our speed indicator, the RSI, it basically tells us that the long-term money managers are just refusing to take profits. They really believe the path of least resistance is up.
Okay, so if the charts are screaming buy, what's happening in the real world to back that up? What are the big macro engines here?
It's kind of a perfect storm. Number one, interest rates. The market is already looking ahead, pricing in the expectation that the Fed is going to start cutting rates in 2026.
And lower rates mean gold just becomes more attractive.
Instantly more attractive. It
Yeah.
lowers the opportunity cost of holding it. Then you have the global slowdown story.
Right, Moody's is forecasting just 2.5% global growth next year. So that means more volatility in stocks, and that money has to go somewhere.
It flees directly to gold. It's the ultimate safe haven. But honestly, the most compelling driver might be the central bank demand. We're not talking small purchases here. You have major players, China, Singapore, the UAE. They are actively hoarding gold to manage their own risk in this sort of fractured world.
That makes sense. It's the only asset that's really outside any single country's control.
Exactly. And that's why you see analysts putting that long-term target as high as $4,200, maybe even $4,300 an ounce.
Okay, but here's the challenge. If the trend is that strong, why are we seeing these short-term dips at all?
You have to see the midterm trend as a necessary breather, a restocking period. The price pulled back from $4,200 down to around $4,080.
Which is healthy, right? Lets the market digest the gains.
It's very healthy. The indicators, like the Bollinger Bands, they show the price is sort of coiling up, getting ready for its next big move. And we have really strong support holding firm between $4,000 and $4,050.
So this current dip then, from around $4,150, that's just a short-term shakeout. What's the immediate pressure from?
It's purely technical profit-taking and a little bit of external friction. You've had a brief recovery in the U.S. dollar and a slight rise in bond yields.
Which makes gold a little less appealing, just for a moment.
On a very short-term basis, yes. It's a technical adjustment, not something that breaks the bigger story.
So let's look at the roadmap for the rest of November. What's the most likely path forward from here?
The probabilities favor an increase, I'd say about 55%. For that to happen, the price needs to hold that $4,050 level and then break through resistance at $4,120.
And that opens the door to what, $4,250?
Potentially, yes. The next most likely scenario, maybe 30%, is just consolidation, moving sideways between $4,050 and $4,120.
And the deep drop.
That's a low probability, only about 15%. But that scenario only really comes into play if that critical psychological support line of $4,000 is broken.
So that $4,000 threshold, that's really the line in the sand.
It absolutely is. As long as we stay above $4,000, gold is fundamentally robust and just poised for its next rally.
So to synthesize this all, long-term increase, mid-term accumulation, and a short-term adjustment. The analysis really confirms that every current dip should be seen as an opportunity.
An opportunity to consolidate and reinforce that primary trend, yes.
But that leaves a final question for you, the listener, to really think about. If sovereign central banks are buying gold this aggressively right now at $4,100 an ounce, what price do they think it will reach in 2030, and how does that completely change how we should all view gold's role in the global financial system?